Okay, so good afternoon, everyone. Thank you for joining us today. Presenting today is Dr. Howard Johnson. He is the Managing Director and Canada Market Leader at Duff and Phelps in Toronto. His topic for this session is selling your business in a post-COVID-19 world. Howard advises business owners and executives on matters such as acquisitions, financing, and shareholder value. He is also the author of several books on the subjects of business valuation and M&A, published by CPA Canada. Howard, good luck on your presentation, and I'll try to come back at the end just to help with closing things out and to see if there's any questions, okay?
Okay, well, thank you very much, and thank you everybody for joining this afternoon. Hopefully everyone can see my presentation okay. So what I'll do is I'll walk through over the next 30 minutes, what's happened over the course of COVID and what we expect the outcome to be as hopefully people get vaccinated over the coming months. So thank you very much for the introduction. So that's just me, and I think that was adequately covered off. And just briefly, for those of you who are familiar with Duff and Phelps, we're actually one of the world's largest independent valuation and corporate finance firms, about 4,000 people throughout the world, mainly in mergers and acquisitions, valuation services, disputes and so if you can just go to our website, duffandphelps.com or kroll.com, which is now the parent company, for a full suite of those. So without further ado, let's hop right into the topic of today. I always like to start with a macro perspective. So what's happened with M&A activity over the past decade? And this chart that we see here has two elements to it. The blue bars that you see is the aggregate enterprise value. So that's the total value of all the businesses that have traded in Canada, i.e. Canadian companies that have been sold in any given year over the past decade, as reported. And the reason that caveat is important is that most transactions that are small or medium size, so companies that sell for 10 million, 50 million, even 100 million, oftentimes the value of those transactions is not reported, and therefore they're not captured in the in that blue bar. It's those mega deals that get captured. So in any given year, we can see that in Canada, usually we have somewhere between $1 billion, $150 billion of business value that gets traded as reported. And of course, in the year 2020, we saw that drop because a lot of the large deals dropped off. The barometer that I prefer to look at is really that red line you see. The red line is the number of transactions as indicated on the right-hand side of the scale. And we can see that in any given year in Canada, there are between roughly 1,500 and 2,000 reported transactions. Now, a lot of those transactions are reported with no value. It just says company B, terms were undisclosed. We see a lot of that. But the message here is that despite all of the mayhem that was caused as a result of the pandemic, there was still an active M&A market in Canada for a lot of smaller and mid-sized companies. The mega deals kind of dried up in 2020, but the baseline activity saw it through and continued business as usual. So what happened in COVID-19? Well, not surprising to most of you is that we've seen this K-shaped recovery. In other words, we've seen some companies that have done very poorly, obviously in things like retail, restaurants, and so on that are struggling. And we are seeing some transactions that are taking place at very discounted levels. But we've also seen other groups that have benefited. Companies, consumer products that sell through retail and online distributors, and some of the technology businesses have had a buoyant time as a result of COVID and just change in what people are doing and how they're doing it. So it is very much a tale of two outcomes. The borrowing environment was quite interesting during COVID. So as I sat here about a year ago, when the quote unquote 2-week lockdown was just kind of underway, things were just a disaster in the in the borrowing environment. I remember trying to negotiate a large financing deal for a company, and every single senior banker that I was dealing with told me the same thing, that it was the most volatile lending environment they had ever experienced in their careers, far beyond what was there in the year of 2008. So certainly in the April, May, June timeframe of last year, the lending environment dried up, and as a result, M&A transaction activity dried up. But that is now behind us, and we've seen the lending environment come back very strong in terms of the number of lenders out there and the terms they're willing to lend on. So that is now behind us. And a couple of things that COVID-19 has done in terms of the due diligence practices. In other words, how buyers are now looking at companies and what they're looking at, the transaction structuring, so how they're doing transactions, and from a seller's perspective, divestiture planning. And these are three things that I'm going to touch on during my presentation. I believe the most telling slide is this next one. So this looks at North American activity, and as you can appreciate, North American activity, tends to have more data points, and therefore it can be more meaningful. But this really tells the story of what happened during COVID. Right? If we look at the left-hand graph, we see the number of transactions and the transaction values just take a terribly sharp drop in the second quarter of last year. So the April to June timeframe of last year, everything dried up. But lo and behold, toward the middle and end of last year, things ramped up so quickly again, and they are now at a point where we are actually much busier than we were pre-COVID. And I have not been this busy in 25 years of doing this business. It is just incredible the amount of M&A activity that has hit the marketplace over the past few months. There is a great buoyancy among buyers and sellers and a lot of capital out there that I will touch on. And of course, the big question for a lot of sellers and buyers is, what about valuation multiples? And this is on the right-hand side, or the right-hand graph. Now, a caveat with valuation multiples of EBITDA, right, earnings before interest, taxes, depreciation, and amortization, does tend to be a very common metric by which business values are based. But it can be misleading because EBITDA does story, and it can be distorted on how you measure it. And certainly this is something that so if we look at the right-hand side, the chart, we see that pre-COVID, in the first quarter of last year, 8 times EBITDA was kind of a norm for mid-market businesses. And remember, a lot of this is U.S. data, so a mid-market transaction is a company between $25 million in value and about $500 million in value. So it tends to be a bit bigger than the average Canadian business, which inflates the multiple a little bit, but it's still a good indicator. We saw that multiple rise to more than 11 times on average by the third quarter, but that is a bit misleading because in a lot of cases that multiple is based on depressed earnings in the second quarter of the year. So just all in aid of be careful when people talk about valuation multiples because they can get distorted. But the real question is, what is driving all of this activity? And the single answer is the abundance of capital in the marketplace. We are at a point where at no other time in history has there been so much capital looking for a home, and you can't find anywhere on the planet to get more than 1% yield without taking on a risk. So a lot of that capital is flowing into the M&A market, and the top chart shows the amount of capital that is on the amount of cash rather that's on the books of Fortune S&P 500 companies, almost $3 trillion US, and the amount of private equity capital that's out there. Right? There's over $1.2 trillion of dry powder looking for a home at the end of 2019. We're just waiting for the 2020 figures to come out, but that's gone up. And this doesn't include the major pension funds, some of the large family offices in the US, and other financial investors. There's just a load of capital. And all things being equal, liquidity creates value. And that's why we're seeing a lot of activity and valuation multiples rapidly returning. But of course, the COVID environment has changed the way that buyers have to look at things. As you've probably noticed, we're doing things a lot more remote. And one of the biggest challenges that I have as a advisor to a lot of clients selling their business in Canada is that I'm selling a lot of these businesses to groups in in Europe, in the US, and so on. I can't get them over the border to view the business. And this, of course, creates challenges. It creates challenges for the buyer because they like to meet the management team. They want to get a sense of the facilities. They want to assess the culture. And some of these due diligence challenges have created certain risks from the buyer's perspective because they can't get that same level of feeling that they had in the pre-COVID time, because you can only do so much remotely. And yes, we can do facility tours remotely and have somebody with a camera. We can have drones flying over the property to get a sense, but it's just not the same. And buyers are starting to recognize that and looking for other ways to satisfy their due diligence requirements. Another big question is normalizing EBITDA. So as I said, EBITDA, interest, taxes, depreciation, amortization, despite its imperfections, is still a leading barometer for how transactions are priced. But normalized EBITDA, in other words, what would EBITDA look like in a normal year? What can I expect going forward? Is always the subject of negotiation and adjustment. And that negotiation and adjustment has really been magnified during the era of COVID because there are a lot of COVID-related costs. But from a buyer's perspective, how do we distinguish between the one-time costs of maybe PP&E and putting up plexiglass and so on, and the ongoing costs of more compliance, et cetera, that are going to permeate through the next few years in order to keep people safe? There could be gains or losses on revenue. So we saw that many companies struggled during COVID, and lost a lot of revenue, particularly around the second quarter of last year, the April to June timeframe, when everybody was adjusting and how to work with the new world. And of course, sellers want to point to that as being not usual and should be added back. But there's the other side of that where some companies actually benefited during COVID. And from a buyer's perspective, they're going to challenge, well, am I buying a company at its peak because all of a sudden the earnings are inflated from the benefits of COVID? So buyers have a lot of extra work to do. There's also the government assistance, all the government programs that are not recurring and will go away that need to be adjusted for. And we also saw foreign exchange. This time last year, the Canadian dollar was sitting down close to 70 cents, and now it's north of 80 cents. So if you are an importer or exporter, obviously that foreign exchange may have a significant impact on your financials, and forward contracts and such can only protect against the near term. So buyers are really having to look hard at the companies that they're acquiring. And what is becoming more important and more prominent, particularly for mid-sized and larger businesses, is to get a quality of earnings analysis and to do it on the sell side to provide that to buyers, to give them comfort and the quality of the cash flows that they're buying. We've also seen more things in the transaction structuring side. So when COVID first broke out, and the banks really froze up in terms of lending, we saw a lot of buyers asking sellers to take promissory notes to fill that gap where they couldn't get funds from banks. Well, that seems to be mostly behind us now because the banks are lending again, at least as strong, in some cases even stronger than they were pre-COVID. We're also seeing, though, a lot of companies that are small cap and mid cap publicly traded companies trading at heights they'd never imagined. I mean, all you have to do is look at the, where the S&P and the Dow Jones are and so on, and you can see that a lot of companies have what appear to be very inflated stock prices. And a lot of public companies will use their shares as currency to undertake some of these acquisitions and preserve cash. And while that can have some near-term tax benefits, it also imposes a lot of risk, particularly if you end up with a large volume of shares within a small cap publicly traded company that are not liquid. You can become what I term a stuckholder, and you're stuck with that investment. It may look good on paper, but it may not be cash in your pocket. There's also earnout mechanisms, right? So an earnout essentially passes the risk from the buyer back to the seller. and say, if you hit certain objectives, if you hit certain areas, I will give you more money. And of course, this places the seller at risk, but also provides more comfort to prospective buyers, because they may say, well, look, I don't know if you had a one-time gain as a result of COVID. Or the seller might say, look, I had a bad year last year because of COVID, and as we come out of it, that won't happen again. And the buyer, of course, is saying, well, I'm not going to pay cash for that, but if that does happen, I will give you more money. So earn-out mechanisms can be complex, and you have to be careful. There can also be other mechanisms, right? Minority investments. So maybe somebody is not ready to sell, but rather they need to right-size their balance sheet because they had so much debt as a result of COVID. They might look for a minority partner who might then want a right of first refusal, or a ROFR, as it's known, in order to pick up the rest of the business at a later date. There could also be the sale of majority position. Private equity firms love that, where they buy 75%, for example, of a business, and the seller retains 25% interest. But in that regard, the shareholders' agreement can be just as important as the purchase agreement, because it dictates the rights, the responsibilities, the privileges, and so on of both the majority and the minority. So the divestiture process itself within the COVID world hasn't really changed, right? There are really what I put into 8 stages of selling a company. The first 3 are what I call the building blocks of what you do before you take a business to market, right? That is the timing of the sale, getting ready for the sale, because look, you only have one chance to make a good first impression, and getting a good sense of value and price so that you know where your negotiation is. And then once you go into the market, there's the execution phase, which is where sellers are engaging the buyers. And I use the word engaging rather than contacting, because anybody can pick up a phone and try to call a prospective buyer. But any quality buyer is going to have 10 or 12 or 15 opportunities in front of them. How do you make sure that yours is on top? How do you engage them so that you create that competitive friction that gets a premium value? Then we get to conveying information back and forth to buyers. And I always tell my clients, it's a two-way street. You have to start learning about the buyers, because ultimately it's about deal structuring and negotiation that are key. And the letter of intent, while it is a non-binding document officially, becomes a pivotal document. Because once you've negotiated that letter of intent, this is where you get into that inflection point of this curve. After that letter of intent, you get to a point where you want to make sure that the deal you end up with, the signed purchase agreement, mirrors that letter of intent and nothing goes wrong. That's the risk area for the seller. The seller's risk is between the time you sign the letter of intent and close the deal. So the golden rule should be no surprises after the letter of intent. So the divestiture process itself really hasn't altered that much, but what has changed is the way that certain things are done, both in the planning phase and in the execution phase. So let's look at those 2. So when we look at the planning phase, your business may have had a bad year, and it may be that as you come out of COVID and things go back to normal, things will get better. So if you're in a position where you can manage that bad year, or maybe just use a modest amount of debt to get through it, maybe waiting out the storm is the best mechanism. But then you have to ask yourself, planning, because I tell all my clients there are 3 parties to every transaction: the buyer, the seller, and the government. And some good tax planning really pays for itself. And if you pay extra taxes, you don't even get a thank you card. So usually when there's an opportunity to do an estate freeze at a lower value, and therefore push more of the gain to, say, a next generation, that's a benefit. Well, if you've had a bad year and you think things are going to improve, it may be a great time for that estate freeze. It may also be a great time to say, let's just write off everything, take huge reserves and so on. So as we come out of this, we're showing, a better 2021, 2022, and so on. And if you're planning down the road, it certainly helps to get rid of all the burden of the COVID-related costs at that time. You also have to think very carefully about management. And this is something that a lot of business owners don't give enough or pay enough attention to before they take their business to market. Because for most business owners, they're actively involved in their business, or they rely on a handful of people. And of course, the concern is, are those people going to be aligned with me? Are they, going to run away as soon as they understand the business is for sale. There's a lot of risk there. And the irony is that most of the good quality employees fear they're going to get fired by a new buyer, whereas the buyer is actually afraid they're going to leave. So you have to make sure that you talk to the management team and those key managers, and that means probably putting an incentive program in place to help you get over the hurdle of the transaction and onward. And yes, there's a cost to it, but the alternative is if you don't have a good, strong management team in place, the value of the business probably declines. You also want to take the time for due diligence preparation and making sure all that normalization makes sense with all the one-time costs that may have been incurred as a result of COVID. And if you're a big enough business, a sell-side quality of earnings may help in that regard. And finally, contingency planning. What if you can't sell? What if you need to, find a manager to run the business for years? What if you needed to, take a different direction, a private equity partner or something else? You need alternatives because ultimately it's a question of negotiation. And negotiation is founded on the number and quality of alternatives that are in front of you. Looking at the execution side, right? When you take the business to market, some thoughts are expanding the universe of buyers. There is a lot of private equity capital looking for a home out there. And yes, a lot of those companies are looking for, a lot of those private equity firms look for large businesses where they can put a check down of $100 million. A lot of Canadian businesses don't fall in that category. But the nice thing is Canadian businesses are great for these bolt-ons where you can add on to a company that has been acquired by a private equity firm. The benefit there is you get both the strategic element from the portfolio company and the private equity firms have cash. You might look at a management buyout as an alternative. And again, a lot of the financial partners are looking to support those things. A lot of you may have heard about these SPACs, these special purpose acquisition companies that are all the rage now and going public. Yes, they can be an avenue, but it's a double-edged sword and there's a lot of risk to it. You have to make sure you understand that before you go to market. There could be alternatives to an outright sale. Maybe you're not ready to sell, but you have a lot of capital in the business. A dividend recap might be the solution to take some money out. You also have to think very about how you structure a transaction. Remember that the terms of a deal are just as important as the price. And while the price might look good, if that money is only coming over time, you have to remember that any dollar not received at closing is a dollar at risk. That's not a bad thing. You just have to ensure the prospective reward is worth the risk. Okay. Be wary of any deals that are conditional on financing, even though things have improved. It's no guarantee, because ultimately it's all about closing risk. You want to minimize to the extent possible the risk between the time you sign a letter of intent and the time that you close. So just looking forward to how we see things happening over the balance of 2021 and into the next year, clearly the downturn in mergers and acquisitions is proving to be short-lived. In fact, my guess is that there's going to be a rush to the exits for many groups in both the US and Canada, given the tax changes. You probably read that Mr. Biden is looking at increasing the capital gains rate in the US, which of course will in fact impact a lot of business owners down there. And if he does that, chances are we're going to see the capital gains inclusion rate in Canada go up as well at some point. We missed it in this budget, fortunately, so we've got a bit of a window, but that can be a huge erosion in value, and I think that's on the minds of a lot of sellers today. There's a lot of good private healthy businesses already returning to market. As I said, I haven't been this busy in 25 years, but there's a lot of capital. And the private equity firms are just dying to see deals because they've got to put that money to work. So we see a very busy 2021. There may be a second wave of distressed sales, right, in restaurants and certain retail because of the prolonged impact of the pandemic, particularly in Canada. But we see a lot of buyers taking a cautious approach, right? We don't see as many of these huge transformative acquisitions, but a lot of small, mid-sized companies that are good bolt-ons and accretive. And I think that's great for a lot of Canadian business owners that fall into that category. So 2021, again, it may be a great year to avoid the higher capital gains rates, but liquidity is the key. And as long as there's liquidity, there will always be bumps, but that underlying liquidity provides a solid foundation for a strong M&A market over the next couple of years. So it kind of tops us up at the top of the hour. For those of you who may be interested in more information on this, back in the old days when we could fly on airplanes, and hopefully again, I used to spend a lot of time writing books, most of which are published by the Chartered Professional Accountants of Canada and available through the CPA store on buying businesses, selling businesses, acquisitions, valuations, all types of fun reading in order to pass the time during the COVID era. So I think that takes us pretty much to the top of the hour, but I certainly do appreciate everybody's time today and wish you all the best and staying safe.
Howard?
Yes.
Hi, sorry. If you don't mind, just before you close out here, in the chat, if you want to put in your contact information, perhaps your LinkedIn as well, for those who are watching, they can, contact you after the presentation if they'd like to.
Yeah, I can certainly do that.
Okay, perfect.
And there I am indeed.
Okay, great. I have that. I see that there. Okay, is there anything else that you would like to add?
Nope, not at this time. I think I ended up right on time, but certainly appreciate everybody's time today.
Okay, perfect. Thank you so much for your presentation, and thank you everyone for watching.
Okay, thank you.